Liberation Day has arrived and we have seen a complete annihilation, in fact a wipeout right across the market, with around $2 trillion being erased from the market just in the last few hours. And now we're seeing extreme fear sitting at the 10 point, something that hasn't been seen in quite a while. Investors clearly very bearish, and perhaps you could argue such a great opportunity for the long-term investors to really take advantage of some great deals in the market, with the forward valuations of companies starting to lower. And that is what we want to investigate in today's episode. We're covering 10 stocks very briefly that have in fact been hammered, pretty much the majority of them today, at least in the double-digit region, where we're going to give you our own interpretation if they are some strong buys. Now the first one is Nike, which is down around 11%. That is just in the last few hours. Over the last year, down 36%, year to date down around 23%, and over the last 10 years, if you've been a shareholder, well, you would be only up around 16%, incredibly poor return, and they are trading today pretty much around the 52-week low with just one buy rating from Wall Street, and they're offering a yield of around 2.5%. However, just after the drop today, their forward PE pretty much sits in line with the average of 33, which is very high. In reality, this is one that you probably may think twice about given their expectations moving forward, given some of the issues they're having just in terms of the company itself, forgetting even the wide implications of tariffs and how they affect the company. But if you are someone that does like to look at dividend yield theory that tells us a company is undervalued when their yield sits above the 5-year, then right now not only is 2.83 above 1.12, but also the highest over the last 5 years. That is one significant undervaluation signal. And we can also highlight that their dividend also looks to be safe at a score of 90, very safe. And when we look at this other model, the blue tunnel, which does give the company's intrinsic price, two things we would point out. The first one is it is declining over the last year, not something you really want to see with companies you're investing in. As time goes on, you want them to be worth more and more. But the second point to note, it is in the midpoint of that blue area, so you could argue reasonable valuation, and that is with the company trading at its 52-week low and down more than 10% in just one day. As we said, we're going to give you our own thoughts on their value, and today for the company, the intrinsic price is $80, the average of the three that we can see on screen. Now, when we do our deeper dives, we do run through each model inputs and outputs. Getting straight to it, it is sitting around $79, and as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers and estimations, whether it's for this company or any others. But based on the current price, we always like to kick off with a 10% MOS, execute on that if it meets the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that today, a buy at $72, then we effectively keep going till it's near the current trading price. And what we're saying, this is now a company that sits at around a 30% MOS. Wall Street and their price target see this at $86 over the next year. That is upside of 51%, one that you could say is an overreaction, not just for the company, but for the wider market. But as always, the company itself, as we've shown in our deeper dives, does have some issues that you do need to take into consideration. And for those that want to see at 35, a buy at $52, and at 40, around 48. As we said though, for Nike, 30% MOS, 51% upside. Give us your thoughts as we go along these stocks today. Now, before we continue, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning, completely free to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to 35 undervalued stocks for the month of April. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a spreadsheet of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, sign up, and read straight away. And for those that did miss Monday's article, you can go ahead and still read it, where you'll be able to obtain a spreadsheet running through all the dividend kings, companies paying a dividend increase for 50 plus years. Lots of information, whether we believe them to be overvalued, undervalued, as well as other points. Now, getting to the next company, we have Starbucks Corporation down 11% just a day, making it flat over the last year. Year to date, down around 3%, and over the last 10 years, it is up around 84%, but you would have still underperformed the S&P, with their all-time highs sitting around the $126 mark, but we are now talking around 4 years ago. They're also trading in the mid to low end of the 52-week range, just one buy rating from Wall Street and a yield payable around 2.5%. In terms of the forward P now, even after the massive drop, we are seeing it pretty much in line with their 5-year average. That is one reasonable signal. But if you do look at dividend yield theory, 2.75 above 2.16, this is an undervaluation signal. And when we do get in fact to the blue tunnel, very similar to the previous company, it is sitting bang in the middle. Again, another reasonable signal, but as always, we don't conclude on any of these based on just one model. We like to run it through our own process, where for Starbucks we get to $90, which is pretty much in line with the current price. So we actually agree with the other models we have just run through. We believe as of now, after the massive drop, you could argue it is trading around its fair price. Now Wall Street, they actually disagree, and they see this at $112 over the next year. That in turn translates to 27% upside, and we'll just give you our MOS at 10%. That is $81 for a buy if you believe that is justified. At 20% around $72, which is probably where we would start to get a little bit more excited about the company, and at 25 around $67. As we said though, Starbucks, we see this now trading at its fair value, with Wall Street estimating 27% over the next year. We then move on to the semiconductor giant Broadcom, which is down around 8% today, although up 18% over the last year. Year to date, down 32%. Over the last 10 years, still massive outperformance of the S&P, up more than 1,100%, trading near its 52-week low with a buy rating from Seeking Alpha, a strong buy from Wall Street, and a yield payable at 1.4%. Now, unlike the previous two, even with the drop we are seeing today, it is trading at a forward valuation of 23, which is above the 5-year of 17, and the yield on offer does sit below the 5-year, so actually both of these, even with the drop, do still signal that Broadcom is overvalued, something that we also get confirmed when looking at this model. The only difference is, over the last few months, the disparity between the fair value and where the company currently trades for has been getting smaller and smaller, so over the next few days, if prices continue to fall, you could perhaps see Broadcom, according to this model, in fair value territory. Now, our intrinsic value of $179 is derived from the DCF model. Now, we'll just explain, on other episodes, we have for Broadcom typically gone between the low to medium, but keeping it consistent with the previous video that we did release today, we want to be a bit more conservative to show you that these companies, high quality, still have some upside. And for Broadcom, we have the lower growth rate at 15%, free cash flow year on year. Over the last 10 years, they have been growing at 33%, and that is a year on year basis. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to 179, indicating 13% upside. But remember, low, medium, and high, 15, 20, 25 respectively, are all fairly subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether in fact it is for Broadcom or any others, but we'll show you full transparency at 20%, $258, 63% upside, and for those that believe it should ultimately be higher, 25%, $367, indicating 132% upside, more than a double from the current value. So taking through the 15%, just to be consistent with the episode earlier on today, you are still getting an MOS at 10%, a buy at 161, at 15%, not quite there yet. So for Broadcom, we see between 10 to 15%, with Wall Street very bullish on this company. They see this at $250, translating to 60% upside over the next 12 months. As always though, do give us your thoughts about these companies as we go along today. This then takes us on to Target Corporation, down 10% today, down 46% over the last year. In fact, nearly losing one half of their market cap over a 12-month period. They've lost around 30% of that just over the last few months, and over the last 10 years, up only around 14%, all-time highs. Again, you'd have to go back nearly 4 years ago at $261, pretty much trading at its 52-week low, with a double buy from both Seeking Alpha and Wall Street, and they do pay quite a significant yield at 4.2%. Now, if we look at the forward P, it does sit at 10, significantly below the 5-year average of 17, and with the updated yield for the drop today at 4.8%, not only well above the 5-year at 2.61, but actually the highest they have offered over the last 5 years, and their dividend does look to be safe with an 80 score, giving us that double severe undervaluation signal. And again, that is confirmed when we do take a look at the model. In fact, the disparity over the last few months has only been increasing, so severe undervaluation does look to be on the cards. Now, our intrinsic value is $140, the average of the four, which will give quite a substantial margin of safety today, and as in fact we do keep on going, you are getting at least 30% up to $98, and at 35, not quite there yet, so sitting somewhere somewhere between 30 to 35% for target, $138 price target for Wall Street, indicating 47% upside, 30% MOS, 47% upside. Does this get you interested in Target Corporation? We then move on to FedEx, which is down around 10% today, down 20% over the last year. Year to date, down 21%. Over the last 10 years, up although barely at 27%. Again, another one trading pretty much around its 52-week low. And again, very similar to Target, double buy from Seeking Alpha and Wall Street, and a yield sitting around the 2.3% point. And also, again, very similar to Target, the forward P lower than the 5-year average, the yield above the 5-year, so a double severe undervaluation signal. And also confirmed when we do take a look at this model, it is sitting even lower than the bottom point. So FedEx has all 3 points showing us severe undervaluation. And our intrinsic value also reflects that here at $306. With the current price at $222, you are getting a very substantial MOS. In fact, at the 30% point, you would have to wait for $214. So we're saying right now, 25 to 30% for FedEx, with Wall Street $292 price target, 32% upside. We've also included Salesforce today, which is a high quality company, down around 5%. Over the last 12 months, down 15%. Year to date, down 23%. Over the last 10 years, still has massively outperformed the S&P, up 281%. Trading near its 52-week low, double buy from both Seeking Alpha and Wall Street, and a yield sitting around the 0.61% point. We can also flag here that the forward P of 23 sits well below the 5-year of 32. In fact, one of the lowest, if not the lowest offered over the last 5 years, giving us that severe undervaluation signal. And we also get that reconfirmed when we do see the disparity between the 2 points. So very possible one to consider in the overall portfolio. And our intrinsic price of $322 again is derived from the lower rate today. We want to keep in line with the theme that we have for the earlier episode. At the 10% point, you are still getting 25% upside, and we can in fact show you are also getting a margin of safety that could make the company fairly attractive. In fact, right now we see 20% MOS at the lower growth rate, with Wall Street very bullish. They see this at $380, translating to 48% upside. And if we did use the typical rate, we would see this at $371, so not far off where Wall Street also believes the company should be. This then brings us to the Walt Disney Company, down 6 to 7% today. In fact, losing 1/4 of its market cap over the last year, down 25%. Year to date, down 18%. Over the last 10 years, down 14%, trading towards the lower end of the 52-week range, a double buy from Seeking Alpha and Wall Street, and a yield pretty much sitting around the 1% point. We also notice the forward P does sit substantially lower, 16.7, with the 5-year average at 23.1, and again reconfirmed when we do take a look at this model, there is quite a large disparity between where it sits, and in fact is only increasing over the last few weeks. Now our intrinsic price is $108, and actually we have used a lower rate than we typically would on the channel, 8%, and as we can see, $108.47, which in turn will still give you a margin of safety, 10%, a buy at $97.63, at 20%, not quite there yet. So for the company, we're seeing pretty much a bang on 15% MOS, with Wall Street again very high upside of 43%. They see this at $130 in just the next 12 months. Lots of opportunity in the market right now, and as always, do give us your thoughts about any of these, and perhaps maybe you have been adding. We then move on to Dell Technologies, down a massive 16% today. In fact, 32% over the last year. Year to date, down a huge 30%. Over the last 5 years though, even with the roller coaster ride, still up 116%, massively outperforming the S&P. Pretty much trading at its 52-week low today. A strong buy from Seeking Alpha, a buy from Wall Street, and a yield sitting around the 2.2% point. And we can also flag the forward P of 8.5 is below the 5-year of 10.4, and with the update to the yield given the drop today, it is sitting above that again, to undervaluation signals noted, and again reconfirmed when we take a look. Good in fact to see the blue tunnel increasing over time. Right now, in fact, for the first time over the last year, it is below that, so severe undervaluation. Something that we can see when we look at the intrinsic value, we note this at $142, so you are talking about a very significant MOS, as we do in fact keep going today. At 40%, it is a buy up to $85. At 45, not quite there yet. So for Dell Technologies, we see 40% MOS. Wall Street incredibly bullish, 73% upside, their price target $140. We then move on to American Express, down more than 8% today. Over the last 12 months, up 11%. Year to date, down 15%. Over the last 10 years, outperforming the S&P, up 217, trading in the lower end of the 52-week range, with just one buy rating today from Seeking Alpha. We also notice the forward P of 16.3 is slightly below the 5-year rolling of 17.8, and you are getting a slightly higher yield than you have done over the last 5 years, so two reasonable / slight undervaluation signals. And pretty much the same conclusion to be said when we do see this sitting right at the bottom of that blue tunnel. Now intrinsic value does come to $325, which as you can see is substantially above the current trading price. At 10%, a buy at 292, at 20 around 260, at 25 not quite there yet, but you are at least getting 20% MOS for American Express, with Wall Street's forecast $325 translating to 29% upside. This then brings us onto Apple, which is down around 8% today. In fact, over the last year, it is up 22%. Year to date, now down nearly 18%. They've lost nearly 1/5 of their market cap in just the last 3 months, but over the last 10 years, still outperforming the S&P, up 549%, trading in the mid to low end of the 52-week range, just one buy rating as well from Wall Street. They're also now not that far off the 5-year average at 27.7, and the yield again not far off the historicals, meaning a potential reasonable signal, and this is also reconfirmed when we take a look here, pretty much sitting around the mid region. Now intrinsic value of $200 derived from the DCF model, we have used the lower rate at 8%, although this is something we pretty much use very consistently when looking at this company, just given the lack of growth we see at least in the short to medium term. But if you believe 10 or 12%, then you are looking between 13 to 30% upside, and if we do look at an MOS, you aren't getting any right now as the intrinsic price is pretty much around the current value, so we do see it trading around fair price. If you want a 10% MOS, a buy at 180, at 20 around 160, and at 30 around 140. But remember, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers here, whether it's for Apple or any others. But as we said, no margin of safety, trading at fair price. Wall Street, however, very bullish as they continually are on Apple, $250 price target, 23% upside. And as always, give us your thoughts about these companies, whether you've been buying, maybe holding, or in fact started to sell. Don't forget, as always, sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells, and also come and join us on the YouTube channel where in fact we do release these videos earlier than others. But as always, have a great day. We'll see you all on the next one.